Um, and Scott Bessent, the current Treasury Secretary, originally talked about fixing that. He said we're going to lower long-term interest rates, and we're going to term out the debt. So far, they've not done that, and they've specifically talked about the fact that because interest rates are higher than they expected them to be, they've blamed the Fed, but for whatever reason, the interest rates are higher than they expected them to be. They're not terming out their debt. They're continuing with the T-bill strategy. Um, in addition, they've already talked about that, when Chairman Powell's term comes up in 2026, or at least his chairmanship term, not his full term, they plan to put someone else in there that's more of a dove. That's more willing to put lower interest rates in place. So the combination of having a Fed that is somewhat supporting, whether they say it out loud or not, somewhat supporting, the large debt load, and tweaking their term structure. So there's not a lot of demand for long-term debt. They can issue more short-term debt, even though that's kind of a bad look. It's kind of an emerging market look, but they have that tool available to them. And then during emergencies, the Fed can step in and buy some. So while there certainly can be periods of volatility and pain in the bond market, I still think they have a ton of ammo for keeping the train on the tracks for any sort of investable time horizon.